So DeFi, decentralized finance, certainly one of the most exciting, one of the most innovative, wild aspects of crypto. And now, of course, once again, in the center of attention, because it is DeFi that creates the opportunities for things like the Terra ecosystem and the UST algo coin. So that's an element of this. It's not the only element, so it's one element. We'll be talking a little bit about that. But we were talking, I think, generally as well about, okay, from an investor's perspective, how do you look at this particular sector? Because it is, in some respects, a mechanism for, an alternative to fixed income, that there is assets that you own, digital assets that can earn a yield in various ways. It could be through staking, it could be through yield farming, and we can talk a little bit about what all that means. And we've got a pretty good panel here. We've got an excellent panel here, who spread across the spectrum of different perspectives and takes on this space. So why don't we go down the line? Alex, you first, introduce yourself, and we'll then get into some questions.
Sure, I'll get kicked off. So I'm Alex. I work for Ledger. We're a security company. We're best known for the Ledger Nano, the world's most popular hardware wallet. I'm a techie, but I ended up running Ledger's enterprise business line. And at Ledger Enterprise, what we do is we build software that helps organizations protect their digital assets and scale their businesses.
Hello, my name is Sean Salloux, and I'm the Chief Revenue Officer and co-founder of Baanx Group. We are an infrastructure provider, a B2B infrastructure provider. So we provide regulated products to unregulated entities, things like exchange, wallet providers. We do things like debit and eventually credit cards, fiat on-off ramps. So we're basically the pipes behind a lot of DeFis and CeFi. So centralized and decentralized finance, we partner and provide the infrastructure.
My name is Michael Silberberg. I'm the head of investor relations at AltTab.Capital. We're a multi-strategy, discretionary hedge fund domiciled in the BVI. I've worked in every instance of the web, 1, 2, and 3. I was at Yahoo and then DoubleClick and then 17 years at Google. So I'm pretty excited about building this next level of infrastructure, and thank you for having me.
Great. Michael, why don't we go to you first? So maybe just to help some of the folks who may or may not be familiar with DeFi, give us some table stakes kind of definitions and what you would advise people who are getting into this space to, what are the most important things they should be thinking about if they're weighing the prospect of investing in DeFi tokens and systems?
Yeah, absolutely. I think, quite frankly, we're actually all from tech backgrounds. Our COO was the head of site reliability at engineering at Microsoft. Our CIO is actually a doctor, but he's also built and sold a couple of security companies. And I really think one of the things that's both exciting in a decentralized finance, but also is very risky, is that you don't have to trust people anymore, right? Rather than meeting a sales guy and them telling you how great they are, like I will about us, you're able to look at the code of a smart contract and see how that code should work. Now, you're only able to look at that if you have someone who's able to read code, read a primary audit, do a governance audit, do a security audit, and it's a very fast-moving environment where there are new channels, new DeFi operators, new opportunity for yield happening all the time. So I really think, there are stable opportunities, and in the last panel we had some of the more enterprise institutional opportunities where they're arbitraging yield, they're taking a safe harbor for you. But I really think being able to understand the tech behind it, if you're going to do it yourself, is crucially important.
So, Sean, you guys provide infrastructure that in some respects, I presume, starts to address some of the issues that Mike was talking about. How do you get the security behind the code and institutional grade products and services? Tell us a little bit about what that's all about. From your
so we're regulated in a number of different places. We also own a piece of a U.S. bank, so we have a lot of regulated products. In counterparty risk, there are lots, DeFi and CeFi is a great way to get yield and get return, but there's, like bonds, there's a whole spectrum. So how much counterparty risk do you want to take? Do you want to know who the person is? What are the sizes? What are the track records? And the infrastructure is based on generations before But what we take is we try to be very transparent, and from an infrastructure, we provide the pipes, but we like to work with people with very good reputations. And we try to stay away from some of the stuff that get double yields. But there's a lot of transparency. And in DeFi lending, it's really an industry that has only existed for a few years, 2-3 years. It's growing, but I think it's a couple trillion. But if you look at asset-backed lending, it's tens of trillions of dollars. So it's a very small piece, but it's growing. And I think, as one of the earlier panelists mentioned, as the world becomes more decentralized and the world becomes more digitized, we're starting to see assets that were bonds and things, gold, real estate, we're starting to see those migrate to digital. So our Baanx's position is regulated, and also we just need to be able to move those assets securely around for various people.
So, Alex, I'll bring you in a moment. We'll talk a little bit about custody and the importance of that. But before we do, for both of you, you mentioned avoiding some of the crazy yields. But in some respects, that is the first use case of DeFi, that there was just the capacity to earn so much more on an asset than you could do in the traditional finance world. And I think also, if I interpret it correctly, it was part of the bootstrapping of the system, that you had to have these incentives for all these market makers and these participants and validators to get involved, and you built it on top of that. But I do think that at the same time, it bred what inherently is always the case when there are kind of outrageous yields being offered, some speculative bubble-like behavior, right? And that may have been a factor in what happened last week. So how do you read that? Because, I mean, without the yields being what they were, is DeFi worth anything? Right? How do you see the trade-off there between the kind of returns that were being offered and the build-out of DeFi versus the dangerous part of it?
Yeah, I think, so I can address both sort of the macro, and then I'll actually talk about UST as well. But last year, one of the big themes in digital assets were that private equity was pouring money into layer one assets, and they were using this to do ecosystem funds. Near Protocol raised a $500 million fund recently. Avalanche raised $250 million. Terra Luna raised $1 billion fund, and this money is used to bootstrap those industries. So oftentimes when you read about good but not insane yields, if you go into the white paper, there's a certain time horizon in which that yield is supposed to drop. A lot of the money is being spent on incentivizing developers to come in. Unfortunately, that leads to a lot of maybe well-funded blockchains or distributed ledgers being able to incentivize developers that have really good ideas for a company to be building on the wrong layers themselves. And some of the spikes, like a really exciting period last year after Avalanche had raised that $250 million, they were yielding on their automatic market maker. So this is doing a liquidity providing to an exchange that's decentralized, and Avalanche's exchange was called Pangolin. It was yielding at 143%, because instead of this company getting a percentage of every exchange that happened, the people loaning them their own asset to keep liquidity in the market are getting a piece of everything. Now, what's really cool now, which wasn't true in 2018, is that the market has gotten a lot more complex. We now have not only synthetics, but actual perpetuals and perpetual swaps. So during that period, we were able to take that yield on while actually shorting our own position in Avalanche. So we were in a delta neutral period. It went from 13 to 5 to 6 to 13. Again, aren't exposed to any of that until it broke out of a 21-day moving average, closed the shorts and rode that up, and cost base to average out. But that was also a yield that was planned to end. So with UST, and we were in UST until Monday, it was a really good opportunity, right? It was the most advanced algorithmic stable coin I've seen so far. I think what they were trying to do was real. I think a sophisticated attacker, and maybe attacker is the wrong word, a more sophisticated trader with the resources was able to make billions of dollars by shorting this ecosystem and short-circuiting it. We got out, we have standard deviation protocol alerts on every single one of our stable coins. So, we get an alert every time it depegs. If it depegs out of the norm, we just pulled all of our resources. And we got out, I don't know, I think it was 94 to 95 cents. But the yield we had gotten for the 6 months before way more than accommodated for that. So I think it's a space that you can't rest on. You have to be really monitoring and watching, but I don't think, there are lots of actors with bad intentions out there, but there are a lot of people who are trying to build for the future too. And I actually think that was the case in this weakness.
But a pretty strong lesson for you all there, like put those alerts in place, Not a bad idea to have those in place, because 93 cents or 94 cents is a lot better than zero. Yes, Michael.
I was going to echo something that. So what we see in DeFi and CeFi, the reason yields can be higher is the infrastructure costs are a lot lower. So if you look at what a high street bank builds with their old tech from the 70s and 80s, the old databases, it takes them 1,000 people. The next generation of banks, the new fintechs, we're doing with a couple of hundred people. And a company like us, we're using the latest technology with blockchain, we're able to do with 1/10 of that. So what's happening is our cost structure is going way down. We can offer products and services a lot cheaper. Now, you can either get really profitable, you can do things at a lower cost, or you can offer higher yield. So when you're cutting out a few layers of the middlemen in between, you can decide, okay, what do you do with that extra bit? And that's where, what excites me about it is I can see the cost structure going down, where everybody in the bank, everybody in the world can have a bank account, a fully functional bank account, for a lot less than they could a few years ago. So that for me, that's really exciting. And also, there could be some speculative, there are always bubbles, but I think everybody here, specifically some of the companies you work for, there were bubbles. But the internet, at one point, I can remember where it was easier to get a job in San Francisco than it was to find an apartment. And I lived through that kind of coming in. But at the same time, the internet, it didn't go away, and there were some very good companies that are doing some amazing things that have created a huge amount of value. So there is some speculation, but the blockchain and the infrastructure that we see, and I think we're investing in trying to build the back ends for, it's not going away, because we can do things for 1/100th the price of a bank. So there's a lot of margin to be had.
I'm going to bring you in just a moment, Alex.
Okay.
You'll be there. But just to maybe the segue here is to pick up on a couple of things that both of you said, right? I think that it's worth thinking about the role that arbitrage opportunities play in the maturing of the ecosystem, and sort of funds like Michael's come in and see these yields, and then you're kind of watching in live, real time, the evolution of an ecosystem as these ridiculous opportunities present themselves and more sophisticated shorting strategies and so forth get brought in. But the other thing that, I think is important there, Sean, is you talk about everybody can get a bank account. One of the really interesting things about DeFi to me is the idea, to some extent, that you're transplanting the old world of, the old very opaque world of Wall Street's, money markets, where interest rates and LIBOR and everything else are set by these, cabals, really, of small groups in a pub somewhere not too far from here. And this is now an open system where everybody, in some degree, gets an opportunity to participate in what that is, that this is an open mechanism for setting rates. And that's an interesting and exciting opportunity, but it comes with a whole host of risks, and we laid them out at the beginning in terms of some of the technical concerns and so forth. But I think it's a pretty good segue to the idea about, okay, what is the optimal way to structure a DeFi relationship? Because the sort of utopian dream is it's all fully decentralized, everybody's anonymous, and this money is just miraculously managed in this really perfect decentralized governance system. But we see day after day all sorts of problems with these. So where do you guys come from? Because you're about Ledger is a decentralized storage and security system, but there's custody within the custody issues within the actual protocols that we need to be thinking about, right?
Completely right. So I think Sean brought up a really good point around taking out some of the intermediaries in the life cycle, which is hugely important, and it does have a really positive contribution effect to the margin and increases the yield that we can then bring forward to the retail audience, right, to our customers. To break things up a little bit, we can go through the value chain at a high level, right? So crypto is all about self-sovereignty, right, and self-custody, so empowering individuals to manage their own digital assets, to manage their own financial future, right? That's really the promise of a distributed ecosystem. Ledger plays a critical role in that by creating hardware wallets, which allow individuals to securely custody their assets, right? So you can take your Nano, we referenced a couple times today and yesterday, which is great. You can hop on a plane and your, 500,000 in crypto comes with you, right? You land, you can start a new life, you can do whatever you need to do. Same exact model applies for DeFi within that context. Now, DeFi is much more complex than just buying and selling your crypto. So you need certain layers within the ecosystem, and that's where, and thank you, Mike, for mentioning that you work with trusted partners, which is great for us. The layering really does come in. So, to do lending and borrowing, for example, you need a certain level of piping. You need certain functionality and capabilities that a bank would provide, but a bank in this ecosystem looks very different than a traditional bank setup, and it's much leaner. And you start with the retail audience, you start with the hardware wallet, right? You start with self-sovereignty. Then you need to introduce a layer for managing the type of capabilities supported by DeFi, and in some cases CeFi, lending, borrowing, other services that individual is going to need, but they're still in control of the decision-making process of what are the services that they're willing to interact with their crypto. And then underneath that, there is a really important layer that we tend to forget, is that the institutions that are building DeFi services need secure access and secure interaction to these crypto networks, right? And that is a critical component, because within DeFi, as distributed as it is, there is pooling. You need to manage these assets. There are certain things they need to do from a governance and traceability perspective to make sure that your retail audience and your retail customer has the right controls in place, right, for their safety, for the safety of their assets. And that's where really Ledger Enterprise plays a critical role at the bottom of that value chain, but creating a secure access point to the crypto networks to support organizations like banks and others to be able to very clearly and effectively manage those assets for their customers. That's a breakdown of the ecosystem.
Right.
But on your first question, which I didn't get to jump into, I actually have a very interesting observation. And for me, I'm not a financial engineer. You guys are much better suited. I'm a technologist, right? So for that, but I have a fundamental thing that might be a little provocative is, yield traditionally, right, isn't about volatility, right? It's not about gaming these types of models. Yield traditionally is about
it's called fixed income for a reason.
Protection of wealth, right?
Yeah.
That's what it is. It's to counter inflationary assets. And actually, the protocols that you can support DeFi in, so Ethereum and other proof of stake protocols, are inflationary assets by definition, because there's more and more assets, tokens being created and put into circulation. So, yield as a concept within this space was created from a staking perspective as a way to counteract the inflationary aspect of the original assets. Everything else that we talk about here, swaps, lending and borrowing, all of these crazy yield farming aspects really all exist because of market inefficiencies. That's at least my hypothesis that I'm sure we'll get plenty of questions for.
Do you agree, you guys, that it's really a reflection of the inefficiency of the system that has generated all these opportunities?
I think specifically for liquidity farming, I think it's a combination of the two, right? And I think you really said it right. If you took a foreign exchange desk, which has thousands of employees around the world and physical locations and all sorts of reporting that they're doing, and you get rid of all of that, but you take half the fee that you were taking before and you just give it to people who are able to loan that liquidity out, there is still a lot of value. And the big Web 2 example was, right, Kodak was 10,000 people in whatever that town was in Pennsylvania. Instagram took their entire market cap with 4 founders at the time that they were acquired. Yep. And all of these things, so there's a lot of gain that can be made on-chain, not speculatively, where value can be shared for people creating these ecosystems, right? Even if you're just thinking savings account, if no one makes any interest on their savings account, right. If every one of us could save onto our ledger, and I've had a Nano for a long time. I really like it. Your savings account, you're not making any interest, but it's totally secure. It's with you all the time. It doesn't require the infrastructure outlay, the OpEx of Bank of America every year. Why are there all those fees? Why does any of this stuff exist when you can walk around with your own financial system?
Yeah.
So would it be fair to say to that this is the direct-to-consumer model for financial services?
Yeah, but it's not only direct to consumer, but also the Ledger itself they're becoming ecosystems. So as a provider, these are the kind of ecosystems that will replace some of the more traditional financial institutions, but still in a regulated way. It's like we're not saying that you shouldn't do it unregulated. The regulators will still be there. It's a good thing. It protects everybody. But it's just much more nimble from an infrastructure perspective.
Okay, so let's touch on that regulation part because it has become a talking point for some time. Right now, with the certainly there's a lot of conversation around regulating stable coins, and we'll see how the fallout from last week plays out in terms of responses from regulators. But the broader question of regulating DeFi has been out there, right? And the question is often, all right, so who's accountable? If it truly is a DAO, a decentralized, autonomous organization that's running this thing collectively to some magical governance system, the idea that the government, a regulator could go after the founding developers who wrote the initial code is kind of a bit scary to people in terms of that level of imposition on the freedom to write code, right? But on the other hand, yeah, there are all these first mover advantages, and there's all sorts of lacks of transparency, and there are rug pulls and everything else that's sort of very, very unnerving and makes for a pretty volatile and difficult experience. Where do you guys come down on this? I mean, it seems like to me regulation is inevitable, but what form should it take?
I mean, as an American, I have a pretty clear standard that we treat digital assets as commodities. Rather they're governance tokens or securities tokens or whatnot. We had to register with the NFA. I had to take a Series 3 so that we can trade derivatives as a CPO, there aren't many crypto questions on that exam. And it just seems like commodity regulation makes a lot of sense. I am generally pretty scared of DAOs. I also went to law school at New York Law School, and quite frankly, without an LLC between you and I'm pretty sure every holder of the token of the DAO is jointly and severably liable under current commercial law, which isn't very good, but is where we are sort of standing. So we welcome regulation, right? We do not want someone with $1 billion to be able to manipulate the market like happened this week. We want relatively clear exchanges. I hear about, not that we're trading a lot of tokenization of physical assets, but I hear about people tokenizing a power plant and a grid network and all of these things. Well, you need an exchange, and whether it's a clearinghouse or not, you still need a centralized exchange. And I was saying it earlier, we get asked if we're going to tokenize our fund, and I can't imagine a scarier ideal. I need to know every investor in our fund. We have to do serious AML on them. I can't have someone selling their interest in our hedge fund to some other guy in a decentralized way. So I think regulation will be great, and I think it's been said in almost every panel. When regulation happens, there are trillions of dollars that are sitting on the sideline that are waiting to flow into the space. They just want a clear understanding of how to flow there.
But don't we lose something, in the regulation is friction, right? Because, Sean, you were talking about the importance of identifying people, the on and off ramps, and if we know who they are, that gives you the security that you're not going to be rug pulled necessarily. But all of that is friction. All of that is, it is less access, and the dream of DeFi is that it's all decentralized. So, I mean, does it... And so Ledger has been built on the very idea that you are in control of your assets and you are self-custody, not somebody else's.
Yeah, well, this is what I really wanted to flag. I think it's kind of a bit of a misnomer, but it's generally accepted by large audiences that regulation is friction. Right? I don't think it has to be fundamentally, right? Like the regulation that we're operating under now in financial services was written 60 years ago, before technology as we know it existed. Right? So for me as an engineer and as a technologist, this is really an opportunity to rewrite the regulation to fit the technical innovation that we're seeing. That opportunity doesn't come along very often. So really, for me, the decentralization aspect and this entire ecosystem that has evolved out of it is really an opportunity to rewrite the book and set ourselves up for another 100 years of efficiency and democratization of financial services, because the current model actually doesn't scale globally and fundamentally, right? Like, so globalization, the next level of globalization, right, isn't mobility, right? It's financial freedom. And it needs to be a different book for that, and this is really an opportunity to work with the regulators, because I think at the end of the day, everybody wins.
Yeah, I think regulation is evolving, and some places it's a little bit faster than others, but you have to welcome it. And even if you can call it friction, a little bit of friction is good if it protects the consumers in something that is a good thing long term. So there'll always be a few bumps along the road, but regulation is good. And I think we own a stake in a U.S. bank. We're regulated in so many jurisdictions. I think besides our development, our regulatory department is probably is the biggest part of our company besides programming. So it's evolving, and we're kind of on the forefront. We're working with a lot of the leaders in it. We're not trying to hide from it. But I have seen some models where they say a walled garden approach, where as long as there's somebody KYCing and looking at people coming in, and once they're in, they can play in DeFi, or once they're in that, and they know who the players are. And I think I was listening to a panel earlier, and they said, law enforcement likes crypto crime because they can trace it. They can trace it back to the wallet, and they can say it's sitting there, and they can tell the whole world it's sitting there, the assets from that crime, and we just got to figure out who owns it. And that's coming, eventually. Yeah.
Mm-hmm. It was actually Nouriel Roubini who said that.
Yeah.
But, so we have time for, I think, just one or maybe two questions. See any hands? Anyone like to ask a question of this august panel? At the back there, yes. Do we have a mic somewhere? So 1, 2, 3, 6,
right
six,
over there.
six back. Would you raise your hand again? Thank you.
Thank you. You spoke a lot about regulation within the DeFi space. As a normal standby on the street, I see DeFi actually, helping a lot of people, giving them access to funds and so forth globally, right? And hopefully, closing the sort of wage gap between people, allowing countries who are not in the developed to get access to money. With all this regulation being spoken about, do you think that once it's regulated, access to these DFIs in, say, poor countries will be made available?
It's a very good question. It's like it's the de-risking question that the Caribbean nations have suffered for so long. It's all good. You have a big compliance team, but what that translates into is that it's too risky to do business in poorer countries. Thoughts on that?
Yeah, well, each jurisdiction has their own regulation, and I think each country will do it kind of differently. And as long as you're complying, it's a good place to start. But then you have things like Bitcoin and Ethereum that are kind of happening outside and kind of above that. But a country can say, this is how we want to regulate it. It's just so new, and governments are busy, so there's a bit of a lag. But we can see it coming. It's happening in the US. It's happening in Europe. There's legalization, all over the world. So I think it's, we think it's happening, and as long as you're careful in how you do it and you work with the regulators, there will be aspects that are local, and then there'll be aspects that are kind of international.
Yeah.
It's something you live with.
I think to that point, to a certain extent, and maybe it doesn't answer your question directly, but I think it's worth mentioning that it's important to decouple regulation and stop using it as an umbrella term, right? Yeah. Regulation itself as a concept exists to mitigate risk. Right, so what we need to do is we need to reinvent and analyze the risk profiles of these new assets and this new technology. It is a global technology. These are global networks. They should continue to drive globalization, and we need to reassess the risk profile of these things, right? So does custody risk still exist? Well, if you hold a nano, you're self-sovereign. No, you don't have any custody risk. Or, well, you have the risk of giving somebody your 24 words, but you need to manage that yourself. But certain risks still apply. apply, right? You have market exposure, right? You have volatility risk, you have other aspects that need to be managed, and that's where regulation needs to be properly applied. But we shouldn't use it as an umbrella term because that brings in a lot of confusion into the space, I think.
Alrighty, that's all we have time for, I'm afraid, so how about a round of applause for the panel?